In 1932, the US dollar was absolutely at record highs, just like Japan suffered last year. We had the dollar at record highs, every other country going off its gold standard, everybody devaluing against the dollar. And as a result, US exporters couldn't sell anything anywhere. We got into trade disputes. You had the Smoot-Hawley Acts. And a lot of people said, oh, well, the Great Depression was caused by trade wars. Actually, that's no different than what Japan is going through. The Japanese yen went up so high, exporters couldn't sell anything, the stock market went down. Interest rates, curiously enough, in 1929 had fallen from 6% back down to 1%, yet the stock market fell to 10 cents on the dollar. So much for lowering interest rates supports a market. We also see the same thing in Japan. Interest rates have fallen to 0.25%. What happens is the level of confidence, and that's really what is critical in any particular situation. In Japan, there's just simply no confidence that things are going to turn around in any short order. Consequently, interest rates can be at 0.25%, and there's no interest in borrowing. We find Japanese corporations that do have outstanding loans, the banks won't allow them to pay it off because they're afraid if they pay it off, there's nobody else to borrow the money from them. So if you're a good AAA risk or at least even a B+ risk in Tokyo, the corporations don't want you to pay it off. I mean, the banks don't want you to pay it off, and unfortunately under their system, they just say, sorry, you can't prepay. So we're dealing with companies that are getting absolutely decimated. They're getting 0.25% on their deposits and still paying 3 and 4% on outstanding loans. This is the government's way of bailing out the banking system. So what we have to realize is that deflation and inflation depend entirely upon your perspective. They both lead to the same place. It's just a question of where is the confidence at that time. If the confidence is strong in government and strong in the currency, then you end up with the Japanese experience, or you end up with the US experience that we had here in 29, where you sell all the assets, you want cash, that's what everybody wants, and that's what you're going for. If you're in a situation where you're still at a crisis, but the confidence is not in the government, but it's outside the government, what happens? You end up with hyperinflation. It goes the opposite way. That's the case for South America, Germany during the 1920s. So it's a matter of where the confidence is as to what you end up with. If you have the confidence strong in government, then you believe in the currency, you're willing to hold it, etc. So the key is, how do we resolve all the crises that we end up in economically, globally? And when you look at it objectively, you see there's always the same thing. It's just a matter of which way it goes, depending upon the confidence. So the problems that we face today are distinctly different than they were in 1929. And there are a lot of things that are developing that we have to keep in mind. One, the problems that we face today is largely due to governments. That's where the lack of confidence is residing everywhere. It's building in just about every political action around the globe, and it's building in all the various different economies. We don't see a high level of confidence in government anywhere we go. In Japan, I call it the Americanization of Japan, and not to be an arrogant American, but what I mean is that in Japan, even back in 1992 to some degree, but certainly back in 1990, if you said Japanese yen would move 3% this way or 3% that way, the typical response that you got in Japan is, oh no, impossible. Or if you said the Nikkei would drop by 5%, oh no, impossible. And the reason they would always come back with was, oh, government would never allow it. Japan, in my experience, I had never seen a society with such a high level of confidence in its government than any place in the world. Today, you go to Japan, and they're like Americans, and that's why I call it the Americanization of Japan, because I think they passed us. They are so skeptical of government. They think they're entirely inept. And and now everybody makes jokes about politicians in Japan. That was just never done before. So you see the confidence level has completely been demoralized over the last, since 1989, over this Great Depression period. It is changing the political structure in Japan just as the Great Depression changed the political structure here in the United States. One of the reasons that the foundation was kind of born was out of Dewey's research into the Great Depression, and he founded the foundation because when he was looking at various different things to try and figure out what had happened, you realize that it wasn't one single thing. Yet from the political process, we have politicians that like to stand up and say, okay, fine, vote for me, and I'll make sure this will never happen again. Well, there isn't a single politician in the world that could have ever possibly made it rain to eliminate the Dust Bowls during the Great Depression. Yet we had 40% of the population employed in the civil workforce. So if agricultural products are completely decimated, that's why unemployment went to 25%. It's not a political issue, it's not an economic issue. Unless you're going to hire an Indian rain dancers to send to Congress, you're not going to solve it. So there's certain things and parameters, and particularly these big, large changes in the world economy. What happens is it's kind of like Murphy's Law. Whatever can go wrong, that all happens at the same time. And that's what the Great Depression was about. It all converges at the same time. Now, in our current situation, the problems that we face today are exactly opposite of what they were in the 1920s. The level of confidence in government has been declining everywhere you go. So you have to ask yourself, okay, fine, historically, how does capital act under those conditions? And I can tell you it does not rush in buying government bonds, it does not rush in buying currency, and it does not rush in with a high level of confidence in government, if that's the one thing everybody's complaining about. What happens is capital moves in the opposite direction. It starts moving into all sorts of tangible assets. It starts moving into stock markets. It starts moving into commodity markets. So what you end up with are more of the hyperinflationary type scenarios. But we've also looked at economies going back great lengths of time, even into the Roman period. And there are a tremendous amount of records where I won't spend a lot of time on, but you can certainly get, we know so much about the Roman period that has survived in the archives of the British Museum, and including interest rates, etc. And what was interesting was that in looking at interest rates that were recorded throughout the Roman Empire, often they would get to dramatically high levels throughout the provinces, but never in the core, not in Rome. And that is for one reason. Some people talk about hyperinflation in the United States. You're not going to see hyperinflation in the United States by any way, shape, or form. Because the United States, in order to get the United States going up to 1,000%, what you would have is everybody else would be at 4,000 or 5,000%. The United States would fold most likely with an inflation rate somewhere above the 30 to 50% level, because the inflation would be much higher elsewhere.